Hi friends, welcome to Adda 24/7. We are in the BFM most important questions and case study series. Here we are covering all the important theory questions as well as numerical case studies. So follow the series till the end, share it with your friends, like the channel, subscribe to the channel, click on the bell icon. Okay, let's move ahead. So today we'll be starting with some numericals. Okay, and then we'll be moving on towards the objective questions. So let us suppose the spot rate of US dollar per euro is spot euro equals to USD 2.53 2.543. It means what? 1 euro equals to dollar 2.543. Okay, this is your currency. This is given. The exchange rate 3 months forward is 1 euro equals to 2.478. So this is for the spot. Okay, and this is for the forward. What is the forward rate given? 1 euro equals to dollar 2.478. So this is the forward rate. Okay, 3 months forward, and spot is 1 euro equals to 2.543. So who is higher? This is higher, right? So it means the currency is at discount. How much discount? Discount is simple, just subtract this. Okay, 2.543 minus 2.478. What will be the answer? It will be 5 over here. Then 13 minus 7 is 6. Right? Then 0. So 0.065. You see this? 65 points. This is always in basis points. So 65 points. Okay. So what will be the forward point? It is minus 65 points. That also discount. Why? Why is minus? Because we are having a discount over here. Okay. Second one. An investor is considering the purchase price of the following bond. So he is planning to purchase. Face value 100. Coupon is 15%. Maturity is 1 year. If she wants a yield of 13%, what is the maximum price she should pay? So kindly note, it's not only he, it should be she also. Of course, we can't be gender biased in this. So face value is 100, coupon rate is 15, maturity 1 year, yield required is 13%. So what is the price of the bond? See here, maximum price means what will be the price of that bond? The price of that bond is like this. Price of the bond is always lump sum plus annuity. Remember, bond has 5 elements. Face value, maturity, coupon. These are all static elements. They don't change. Dynamic means market price and market rate. These two change. So this is the overall picture of the bond. Okay, and in this, always one will be asked. So here now market price is asked. This is asked. Remaining 4 things are given. Market rate is given, face value is given, maturity is given, coupon is given. Okay. So always the present value of the bond is equal to lump sum plus annuity. What is lump sum? Lump sum means whatever the end amount I will be getting in one stroke, face value amount, that I will be getting. So present value of that. What is the formula for that? F upon 1 plus R raised to N. What is F? Face value. What is R? R is 13%. N is what? Maturity, period, 1 year. So 100 upon 1.13 raised to 1. So 100 upon 1.13. So it is 88.49. You can do the calculations. Everyone try this. And next part is annuity, coupon. The coupons which I will be getting for the remaining 1 year. Okay. So that I will be discounting. How many coupons will I get? If the maturity is 1 year, I will get only 1 coupon. Isn't it? So for that you use this formula. Annuity equals to C into 1 plus R raised to N minus 1 upon R into 1 plus R raised to N. This is a annuity formula, and that is which one? Which is the annuity called as? There are 2 types of annuities, right? One is at the end and second is at the beginning. Annuity due and second is common annuity, correct? So this is common, at the end we get it. So C is what? Coupon, 15%. 15% on 100, so 15 rupees. 15 into 1 plus R raised to N, so that is same 1.13 raised to N, the same one which we got earlier, 1.13 minus 1 upon R. R is 0.13 into again 1 plus R raised to N. 1.13 raised to 1. So 1.13 minus 1, it becomes 0.13. This gets cancelled. So 15 upon 1.13. This is your answer. So 15 upon 1.13 is what? 13.27. So your present value of the bond is what? 88.49 plus 13.27. So if you add this, you'll get it as 101.76. Okay. So this is the way you find out the price of that bond. And the female and the investor who's planning to invest, she should give maximum this much amount. Okay. Okay. Now before going ahead, we'll be moving to the theory questions now. Before that, everyone subscribe to Officers Adda 24/7 English channel as well as Hindi. Join the crash course ASAP because days are very few for the exam. And in this crash course, all the important numericals, case studies, objective questions are covered. You can join the Mahapacks also. Huge discounts are available. I'll show you at the end how to join it. Let's move on with the theory questions. Which of the following is not correct regarding OTC products? OTC means what? Over the counter. What are over the counter? Means which are directly exchanged with the customer on the counter. Means like simple example, I'll give you FD. Fixed deposit. Fixed deposit is an OTC product. Over the counter. Means there is no brain work required in this fixed deposit, right? Rates are given. You have to just follow the rates and move on, right? So what is not correct here? Again, the main point which I always stress in all the lectures is you have to check whether it's a positive question or negative. So this is a negative question. Okay. The derivative products that are indirectly negotiated and obtained from the banks. These are OTC products. These are mostly used for hedging the underlying risk. The price is quoted by the bank and all A, B and C. So what is the answer? Here, not correct. You don't want the correct one, huh? You want the not correct. Indirectly negotiated. What do you mean by indirectly negotiated? Here, there are two types of derivatives. Okay, derivatives are of two types. These are of two types. Okay, one is traded in the exchange. Exchange means traded. I'll write it. Traded in exchange. And second one is directly brought from the bank, purchased from the bank, or with the bank. Brought from the bank. Means over the counter. Okay, from the bank. Okay. So which are those? See, there are many assets. Let me give you one example of this. One is this what? Options and futures. Okay, futures. These are traded in the exchanges. Which are the ones which are brought from the bank? This is forward market, right? Forward. Okay. So this forward is brought from the market, right? There are many swaps. Swaps are also brought from the bank assets, not from the market. Okay. So indirectly traded. So are these the derivative products which are indirectly traded? See this. OTC means which are traded in the exchange. These are OTC. Okay, but these are not OTC. Brought from the bank. This is not OTC. So this is false. These are mostly used for hedging the underlying risk. That is obvious. Here, hedging is, this point is common for both. For traded in the exchange also and brought from the bank also. It is common for both. The price is quoted by the bank. Okay, so here OTC we are talking of, OTC. So here the price will be quoted by the bank only. Even if it is OTC, you'll say, how come sir? How come OTC quoted by the bank? Because it is traded in the exchange. Here, bank will add its margin to it. Traded means what? That is the base rate given in the exchange. But bank will add the margin. So the answer over here is not correct. That is A. Okay. A is the answer which is not correct. Remember this. When parties enter into the contract to deliver foreign currency on the future date at a fixed exchange rate, it is known as foreign currency into a future on a future date, okay, with a fixed exchange rate, fixed, okay. So it is known as what? Forward, future, options and swaps. What is it called as? It is called as, everyone, yes, comment section, write in the comment section please. Yeah, it is called as, okay, I'll give you the options in this. It's either forward or futures, either of these two, okay. Now the hint is given. The answer is forward. This is the answer, forward, okay. See here, what are futures here? Or remember one thing, future and forward are similar. Similar, I won't say same. Only the difference is, in forward there are two parties. Forward, there are two parties. Two parties. Two parties means buyer and a seller. Okay? Buyer and a seller. Buyer and seller. Okay? These are the two parties. In future, there are three parties. Three parties. Okay? Which are those three parties? These two are the same. I'll mark them as they are. Okay? Plus third one is exchange. Exchange. Okay? This is the third party. So always remember, future is a regulated forward. Regulated means there is the exchange who deals with all the regulations. Here the rules and regulations are decided by these two parties only. Okay? So future is a regulated forward. Got it? Clear? Next one. So options and swap I'll explain someday later whenever the topic comes. Okay? When the buyer has to pay the interest in rupees and principal in USD, the borrower may hedge only interest rate. It is known as principal only swap, currency only swap, coupon only swap and interest only swap. What is this called as? See here, buyer has to pay the interest in rupees and principal in USD. So this borrower may hedge the interest rate in what? Hedge only interest rate. It is known as what? Interest only. Now all of you, I am seeing the answer. Majority of you are typing this. Interest only. Okay, because the word interest is there. Because the word interest is there, all of you are typing interest only, sir. But the answer is wrong. Answer is coupon only. See here, the interest rate on any bond or any fixed payment is known as coupon in international market. So this is called as coupon only swap, not interest only swap. Okay. See here, when the currency is hedged with the, it will be the principal only swap, means currency complete, only one currency. When only currency is hedged, it's called as principal only swap. When the interest is hedged, it is called as coupon only swap. Okay. When the buyer has to pay the interest in rupees and principal in USD, this case, the borrower may hedge only the interest rate. It is known as coupon only. See here, logic is very simple. See here, what will I hedge? Hedge means what? Reducing the risk. Reducing. Where will my risk be reduced? Here, I am getting principal in USD and interest in rupees. Okay. Now imagine, here we are talking the borrower or the buyer. Okay, borrower or buyer. So both are same. So here we are talking the borrower or buyer is from other country, is let's say USA. Borrower or buyer is from USA. Borrower is from USA. That's what the logic is. Understand the logic of the question. Okay, the borrower is of USA. So this borrower is getting principal in USD. So the borrower has no problem, he or she, right? Same USD. No currency problem, but rupee is a problem, because rupees this borrower will have to convert it into dollars. So this rupees needs to be converted into dollars. So here it's a risk. And wherever there is a risk, hedging is done. Right? So that's why it's called as coupon only. Let's solve this. This is a big case study. Huh? This, I think so, it will consume almost what, 10 minutes roughly. Let's see, because this is a very important case study. It comes for 5 marks in the exam. So XYZ Limited has RWA, risk weighted assets. If the credit and the operational risk are 5,000 crore, market risk is 2,000 crore, paid up capital is 100 crores, free reserves is 200 crores, PNCP, perpetual non-cumulative preference shares, is 300 crores, provisions for contingencies, it's 100 crores, revaluation reserves, these are 200 crores, subordinate debt, that's 100 crores. Calculate the total capital of XYZ Limited approximately. Okay, so you have to calculate the total capital, simple. Okay, total capital you have to calculate. Now let's see how to calculate the capital. Firstly, understand the formula. Where has this come from? This has come from CRAR. CRAR is known as Cook's ratio. So capital upon RWA. Capital upon RWA, risk weighted asset. Okay, that is Cook's ratio. Okay, now you have to calculate the total capital. Capital means what? You want T1 plus T2, Tier 1 plus T2. See here, capital is of 2 types. It's of 3 types. T2. T3 is known as emergency capital. Emergency. So we don't take that into calculations. Emergency. Okay. So T3 is the emergency capital. We don't take that in calculation. So only T1 and T2. T1 is known as a free capital. What does T1 include? T1 is known as a free capital. Going concern. Going free capital. Here it includes 4 elements. One is shares. Second is net profit. Third is reserves and surplus, R&S. And fourth is revaluation reserves. These are the 4 elements in T1 capital. Revaluation reserves. Okay. 4 elements in this T1 capital. Okay. T2 capital. What does it include? T2 is a gone concern. T2 is known as a gone concern. Paid up. Okay. Gone concern. So gone means what? It's already paid. Interest. Fixed interest. I'll call it fixed interest because here you have to pay fixed interest. Means what? Suppose if I take a loan from the bank for my business, I'm starting a business, I take a loan from the bank. So whether my business will run or not run, I'll have to pay the fixed interest to the bank. So that is known as T2. Other than these 4 elements, all the elements are in T2. So all these now you will be seeing provision for contingencies. Okay. These are all in T2. Yeah, one more thing in T1 is there. 2 things I didn't mention it over here. This is for CT1 actually. This part is here. Again I'll write it. T1 is of 2 types. T1 is of 2 types. Okay, 2 parts it is. One is CT1, common equity tier 1. And second one is known as AT1, additional tier 1. So CT1 has these 4 elements, whichever I have written it just now. I'll just write the short forms now. Shares, net profit, reserves and surplus, and revaluation reserves, RR. Okay. So these 4 elements which are over here. Okay, these 4 elements. So they are in CT1. AT1 we have 2 more elements. One is PNCP, perpetual non-cumulative preference shares, and IPDI, innovative perpetual debt instruments. These are the part in AT1. Got it? AT1. Are you able to see this? Shall I write it somewhere else? One sec. Let me write it over here. AT1. So that consists of PNCP and IPDI. Got it? So now you have to calculate this T1 and T2 capital both. So how to calculate it? See this. If the credit and operational risk is given as 5,000 crores, market risk is given as 2,000 crores, paid up capital is 100 crores. So now go on calculating. So T1 capital is what? T1 capital is directly, can we find it out? Yeah, I think so we are having it now. What are we having it? Paid up capital 100 crores. See this, paid up means what? This is shares. So this 100 I'll add. Then free reserves means reserves and surplus 200 crores. That also I'll add. PNCP, that is also a part of T1 only. So 300 I'll add. Provision for contingency, that's not a part of T1. Okay. Revaluation reserves, yes, this is, but revaluation reserves are always taken at 55% discount. See this, one important part about RR is always taken at 45%. I'll directly write it. Whatever is the figure, take 45%. Means 55% discount we call it. So now T1 will be what? T1. Go on adding 100 crores, that is paid up. 100 crores paid up, plus free reserves 200 crores, plus what? PNCP 300 crores, plus what? Contingencies. This is the part of T2. This I'll write it 2 over here. Okay. Revaluation reserves 200 crores, but that I'll take it at what? 45%. So plus 200 into 45%. 45%, whatever that figure is. Okay, so 90, I think so, right? Subordinate debt, that's a part of T2. This is 2. Okay, so now calculate it. So my T1 is what? T1 is 100 plus 200 plus 300 plus this 90, right? So 3 plus 3 6, 6 plus 290, 690. This is my T1 capital, 690 CR. Okay, what is my T2 now? T2 capital equals to, see this, what's remaining now? T2, this 200 crores. What is that? Free reserves, anything over here? Market risk, let me see. Okay, now let's focus on T2. T2. So T2 equals to what? Market risk 2000, paid up capital, free reserves 200, not there, PNCP not there, provision for contingencies 100 crores. See this provision for contingencies, it's always taken at 1.25% of RWA or given figure, whichever is higher. See here 1.25% of RWA or given figure. Okay, given figure. Okay, 1.25% of RWA or given figure, whichever is what, higher or lower? Whichever is. Does anyone know this? Whichever is. Yeah. What is it? Higher or lower? Whichever is higher. Okay, whichever is higher. So higher of these two. Higher. So now go on calculating. So what is the answer? 1.25% of what is RWA now? 1.25% risk weighted asset. It's already given over here. See this, RWA for credit and ops together is 5000 and market risk is 2000. So add it, combine them now. 5 plus 2 7, so 7000. 1.25% of 7000. Okay, so find it. Plus, now this is 1, but second is what? Provision for contingencies 100 crores. Okay. Yeah. Okay, provision for contingencies is given as 100 crores. So now what will you do in this provisions for contingencies? So we'll have to adjust between these two figures, right? 1.25% of 7000 or 100 CR, right? Whichever is higher. Look at this, 100 CR is given in the question. Provisions for contingencies 100 CR. So 100 CR or 1.25% of 7000, whichever is higher. Okay. Plus, which is the second one? Subordinate debt, that is 100 crores. So take it as it is. Subordinate is as it is. So 100. What is my answer now? Here higher I have to take. Here 7000 and 1.25%. So it is what? Roughly around 87 point something or 77, right? Calculate it. Everyone calculate this. 1.25% of 7000. So what is the answer? Okay. 1.25 into 7000, right? Divided by 100. Divided by 100. So it is 87.5. Okay. So you are getting this figure as 87.5. So now 87.5 or 100, whichever is higher. So it is 100. So I'll take this as 100 plus 100. So that is equal to 200 CR. So what is my total capital now? 690 plus 200. So my total capital is 690. Where is the space? Let me see. This full slide is packed, right? So I'll write it over here. Final figure 690 plus 200. So that is equal to 890, right? 890. This is my total capital and this is what is required approx. Okay. So 890 is my total capital. That's why I said this case study will take around 10 minutes because 5 minutes go for explanation. What is this case study about? What is T1? What is T2? What is CET1? What is 81? All these things require some time, right? Otherwise, what happens? Only this part, if I have to show you this calculation, that can be done in hardly how many? 2 minutes. So got the answer. See, this big case study is asked in exam many times. In fact, it is a must for every BFM exam. There can't be a BFM exam where tier 2, tier 1 CRAR is not asked. Focus on it very clearly and rewind this video again and again. Now, as I told you, I'll be showing you how to join the Adda 24/7 classes at the end. Go to Adda 24/7. Always go through the app. In the app, you get 1% extra. So go to Adda 24/7. Click on JAIIB and CAIIB. Click on CAIIB November. Okay, see this. Join the crash course. Crash course. Okay. Ebooks, test series, online live classes, expert faculties, interactive classes, recorded videos. This is also very important. You're getting everything. And at what cost? Click on buy now. Put the code Y432. See this. Y432. Click on apply. 77% discount you're getting plus 1% extra using the app. So join it ASAP. 78%. Huge. Also, you can join the Mahapack. In Mahapack, you are getting 15 plus batches per subject. Plus, you are getting the marathons also. Plus, you are getting the electives also. So, join ASAP. Again, never forget the code Y432 for maximum discounts. Okay.